It's hard to talk about mortgage interest rates without mentioning the Fed and its chairman, Jerome Powell. Lately, the most common news we get is another rate hike.
We've raised the federal funds rate now by 525 basis points since March 2022.
But did you know that the Fed's decision aren't the only factor influencing the interest rates you get on your mortgage? And the best thing is that you can do both, increase and decrease your monthly payment, regardless of the Federal Reserve's announcement. How? That's what you learn after watching this video. Where did mortgages even come from? And was the Fed always the one who determined the rates for Americans?
But wait, here's good news from American National Bank. A free mortgage adventure kit. All the tools to make getting a mortgage easy.
Well, the first mortgages appear much earlier than this 1998 commercial. Much earlier. The history of mortgage loans can be traced back to the 5th century when Persians and Romans started offering loans with interest. I won't overwhelm you with the history. So, long story short, this man, Emperor Claudius, introduced Roman law and customs to Britain. That's how Brits started to get loans for land and real estate. The mortgages of that time were nothing like today's mortgages. Loans in medieval England had unpredictable terms. Lenders had the power to demand repayment at any time. Non-compliance could lead to legal action, resulting in the borrower losing their land to the lender. Now, let's fast forward a couple of centuries until the British brought this practice to the US. Before 1930, these loans were small, covering half of a home's market value. They were short-term, usually maturing in under 10 years, with payments due only twice a year. Borrowers often paid little or nothing towards the principal, and some made only a few payments before maturity. When debtors couldn't pay off these loans, they had to refinance them. The main problem back then was the absence of stability, which led to a series of financial panics. As a result, the Federal Reserve Act was introduced in 1913, creating the Fed as a central control of the monetary system to alleviate financial crisis. This helped a little until the Great Depression, when the U.S. banking system collapsed. This resulted in a housing market crisis. Most homeowners couldn't pay off or refinance their mortgages. This led to a daily surge of over 1,000 foreclosures in 1933, causing steep drops in housing prices. The government established new agencies to stabilize the real estate market. One of these was the Federal Housing Administration, also known as FHA. It provided mortgage insurance to protect lenders in case of default. Another agency, the Homeowners Loan Corp, founded in 1933, purchased defaulted short-term interest-only mortgages and transformed them into new 15-year loans. These new loans had monthly payments that cover both principal and interest, with fixed interest that remained constant throughout the mortgage term. The corporation operated for 3 years, pioneering long-term mortgages in the US. And this was a game changer that contributed a lot to the mortgage system we know today. In 1938, Congress created the Federal National Mortgage Association, popularly known as Fannie Mae. This government-sponsored enterprise made long-term fixed-rate mortgages viable through securitization. Fannie Mae sold the debt to investors and used the proceeds to buy these long-term mortgage loans from banks. This process reduced risk for banks and encouraged long-term mortgage lending, but it still wasn't the popular 30-year mortgage we know today. This one appeared only after World War II. Back then, Congress allowed the FHA to insure 30-year loans for new and existing homes. Fixed rates were the most widespread option until 1966, when a credit crunch and later inflation made adjustable rate mortgages, ARMs, more popular. ARMs offer lower initial rates than 15 or 30-year fixed-rate mortgages, but those rates are then adjusted in future years according to market conditions. Surprisingly, Americans favor fixed-rate mortgages, unlike most nations globally who prefer ARMs. And now, We see a great example of why this might be a good decision, as many people in the US kept a much lower interest rate compared to what we have now. In 1971, Freddie Mac began tracking mortgage rates. In the early years, they were between 7 and 8%. Entering the 1980s, a recession triggered by the oil crisis led to high inflation, pushing mortgage rates higher. The Fed raised short-term interest rates to stimulate the economy, resulting in higher home buying costs. In 1980, the annual rate was almost 14%, peaking at 16.63% in 1981, the highest recorded by Freddie Mac. The 90s marked a significant shift compared to the prior decade. Inflation eased, and except for 1990, no year ended with double-digit mortgage rates. Entering the 2000s, rates rose to 8%, but the rest of the decade saw yearly averages below 7%. To revive the market, the Fed reduced interest rates to stimulate the economy and make borrowing more affordable. The decade of 2010 saw quite steady mortgage rates between 3 and 5%. Freddie Mac recorded the lowest ever mortgage rates in 2020 and 2021. The Fed cut the federal funds rate to 0.25% during the pandemic to promote borrowing. This move stimulated the economy but led to the crazily overheated housing market. The current average 30-year fixed mortgage interest rate is 7.78%. That's the highest level since December 2000. The current rate for a 15-year fixed-rate mortgage is 6.54%. If you've seen the recent rate fluctuations, you might wonder about the connection between the Fed rates and mortgages. The Fed's primary role is to shape monetary policy to maintain low inflation, around 2%, price stability, and high employment. It employs open market operations involving the buying and selling of U.S. Treasury securities and mortgage-backed securities. This impacts the availability and cost of credit, affecting people's stability to get loans. This bond market influences the federal funds rate. When the Fed sells bonds, the federal funds rate goes up. And when the Federal Reserve buys bonds, the rate decreases. This shift in the Fed funds rate indirectly impacts mortgage rates. What does indirectly mean? You see, the Fed funds rate is the interest at which banks lend money to each other. Banks with excess reserves can lend to those in deficit. This helps ensure the availability of funds for consumers and businesses when required. The Fed raises rates when inflation is high to make borrowing more expensive. This can help control inflation. Meanwhile, mortgage rates often rise when unemployment decreases and fall when unemployment increases. So you might be under the impression that the Fed determines your mortgage interest rate. Well, that's not entirely true. The Fed's rate is only one component that influences your interest rate. The other ones are, well, one of the most crucial factors determining your mortgage is the FICO credit score. It was developed in 1954 by the Fair Isaac Corporation. FICO helps lender assess credit risk. Thus, they can decide whether to grant credit by considering borrowers' credit reports and scores. FICO scores consider 5 factors to decide a borrower's creditworthiness: payment history, representing a 35% of the total score, current debt levels, 30%, credit types, 10%, credit history length, 15%, and new credit accounts, 10%. FICO scores span from 300 to 850. Typically, scores between 670 and 739 are seen as good, which most lenders view favorably. On the other hand, individuals with scores between 580 and 669 might encounter challenges in securing favorable financial rates. Other crucial factors that influence your interest rates are loan-to-value, LTV, and debt-to-income, DTI, ratios. The LTV ratio measures your loan amount in relation to the property's price. A lower LTV often leads to a reduced mortgage rate. Your down payment determines your LTV. The higher your down payment, the lower your LTV, and the more favorable your creditworthiness appear. For example, a 20% down payment equals an 80% LTV. Your DTI ratio measures your financial stability and the ability to handle debt. It's calculated by dividing your total monthly debt by your monthly gross income. In essence, it indicates how risky you may appear to a lender. Generally, a higher DTI ratio leads to higher interest rates. Most conventional loans cap DTI at 45%, but some lenders might accept ratios up to 50% if there are compensating factors, like having savings equal to 6 months' housing expenses. To secure the best rates, the rule of thumb is to aim for a DTI of 36% or less. I personally prefer to keep it in the 30% just to play it safe. Another thing that affects your mortgage rate is the loan amount. Generally, a higher sum often results in a lower mortgage rate for borrowers. It provides the lender with a larger profit margin. In essence, better rates are available for debtors with more significant credit amounts. But, of course, you need solid financial credentials to prove your ability to manage a larger loan. The next thing is closing costs. Both the amount and timing of payment can impact your mortgage rate. Thus, rolling your closing costs into the loan instead of paying them upfront could result in a higher mortgage rate. And finally, there are discount points. There are optional fees paid upfront to the lender during closing to secure a lower mortgage rate. So, when we know what factors influence the mortgage rate, we can determine how to decrease it ourselves. There are quite a few methods, but they are most effective when you work on all of them. First, boost your credit score for a better mortgage rate, regardless of your loan choice. Lenders associate higher scores with lower risk, resulting in improved rates and lower payments. Even with an existing loan, you can improve your credit score by paying on time, paying off debt, and correcting reports error. In this video, you can find more details on how to secure a perfect FICO score. The second thing you can do to decrease your interest rate is to try to use a first-time homebuyer mortgage program. This way, you can access government and community mortgage programs for lower rates and incentive, like closing cost grants and low down payment loans. Next, consider adjusting your closing day in 15-day increments to secure a lower mortgage rate. Lenders often raise rates by 0.125% for each extra 15 days in a rate lock. You can choose a 30-day safety for the best rate, as 90-day locks tend to have higher rates. Thus, select closing dates within these 15-day windows when making your purchase offer. You can also reduce your interest rates by paying mortgage discount points as upfront fees at closing. Each point costs 1% of your loan amount and can lower your rate by around 0.25%. When locking your rate, inquire about various discount point choices to find the most suitable option. In fact, in this video, I show you how to do it, so make sure you watch it when you're done with this one. Increasing your down payment can result in lower mortgage rates, especially for those with strong credit score. Every extra 5% down may reduce your rate by 0.125%, but savings begin after reaching a 20% down payment. This strategy applies to conventional loans, as other loan types tend to use different pricing models. To lower your mortgage interest rate, you can obtain multiple quotes. Fannie Mae research indicates that home buyers who receive at least 2 mortgage rate quotes can save up to $1,500 over the life of their loan in terms of closing costs, interest rate savings, or both. Those who gather more than 4 quotes typically save an average of $5,000. Examine using seller concessions. This is an agreement where the seller covers some or all of your closing costs, including mortgage discount points. These concessions are negotiated during the sale. Depending on the mortgage and down payment size, concessions can amount to as much as 9% of the purchase price. Yet, seller concessions are primarily for covering closing costs and cannot be applied to the down payment, commissions, or other non-closing fees. Consider a temporary mortgage rate buy-down. This tool enhances home affordability by reducing your mortgage rate for up to 3 years. These buy-downs are named after their duration, like a 3-2-1 buy-down. This means the interest rate drops by 3 percentage points in the first year, 2 in the second year, and 1 in the third year. After that, the original rate returns for the rest of the loan term. For instance, a 2-1 buy down could save you $8,000 in mortgage interest. Evaluate the use of Home Ready or Home Possible mortgage programs offered by Fannie Mae and Freddie Mac to lower mortgage rates. These programs are designed for home buyers in low and moderate income neighborhoods. They are part of the government's Affordable Housing Initiative. Eligible participants can access mortgage rates at least half a percentage point lower than standard 30-year rates, lower mortgage insurance rate, and reduce closing costs. Try to get a shorter loan term, such as 10 or 15 years, to secure a lower mortgage rate. Lenders prefer faster loan repayments, and shorter terms typically come with a lower interest rate. This accelerates your loan balance reduction and helps build home equity more quickly. While the Fed can influence your mortgage rate, they're not the only ones influencing it. That's great news, especially with today's rate closing at 8%. Now you know you can take control of the situation and potentially decrease your interest rate. Have you tried lowering your mortgage rate before? If so, how did it go? Let us know down in the comments, and I'll see you in the next video. Take care. Bye-bye.